Welcome back to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan. Today we're diving into some of the latest developments shaking up Canada's housing sector. In this segment, we're turning our attention to the federal government's recent adjustments to mortgage rules, which have sparked quite the debate across the industry. Canada's mortgage industry is buzzing with reactions to the federal government's new changes aimed at improving housing affordability for certain buyers. The adjustments, which will take effect on December 15th, include raising the cap on insured mortgages from $1 million to $1.5 million. Additionally, there's an expanded 30-year amortization option for first-time buyers and those purchasing new builds. These changes have been largely welcomed by industry insiders who appreciate the government's willingness to adapt policies in response to economic and market pressures. However, not everyone is convinced that these adjustments will benefit those who need it most. Concerns about long-term affordability and supply shortages continue to fuel debate. Rate expert Ryan Sims did not hold back in his weekly newsletter, calling the changes a band-aid solution. He argued that extending the amortization period does not address the root cause of high housing costs. Increasing the amortization does not lower the cost of housing, Sims said. Extending the payments out longer does nothing to fix the root cause of the issue. It simply masks the symptoms. Ben Salami, founder and chief executive officer of Canadian mortgage app, echoed similar concerns. Salami pointed out that the numbers do not quite add up, especially for first-time buyers struggling to enter the market. Under the new December 15th rules, a purchase price of $1,499,999 with a minimum down payment of $124,999.90 incurs a staggering insurance premium of $57,750. He posted in a group for industry professionals. Not to mention, the income required to qualify for this mortgage is approximately $327,000. Salami later reflected on the changes in an interview with Canadian Mortgage Trends, expressing support for the extended amortization periods, but emphasizing that he would have preferred adjustments to the government's stress test requirements instead. "The required income is what kills it," he said. "It's not so much the minimum down payment. We have a bigger problem with the qualification piece." Other industry members believe the changes could benefit more than just first-time buyers in the short term, suggesting they may also drive long-term development of much-needed missing middle housing. Dustin Woodhouse, in his Be the Better Broker blog, noted that the new rules send a signal to developers to build a more diverse range of housing options. It's a signal, one of many, being sent to developers to inspire them to build something other than studio, one-bed, and two-bed condos, and those odd-feeling two-bedroom townhouses, he argued. Tyler Cowell, the principal broker at Mortgage Foundations, was surprised by the government's decision to raise the insured mortgage cap to $1.5 million. "The industry was asking for $1.25 million. We were told no constantly, and then all of a sudden it's $1.5 million, he said. "It's such a high income level that's needed to qualify, so it just brings in high income with low leverage, and that introduces future risk." Cowell added that, in his view, the changes favor existing homeowners more than those trying to enter the market, noting that the former group tends to vote in federal elections more frequently. He explained that raising the insured mortgage cap broadens the buyer pool for current homeowners, while the 30-year amortization extension benefits both new and existing buyers. It allows first-time homebuyers, who are actually buying homes that are affordable and are realistic, to get into the market, he said. At the same time, for the existing homeowner, that buyer who could only afford $500,000 can now spend $550,000, so the demand is going to send home prices even higher so that one serves to benefit both. As brokers continue to weigh the long-term implications of the policy changes, Canada's major mortgage insurance providers have applauded the federal government's flexibility and responsiveness. Stuart Levings, president and chief executive officer of Sagan, stated, "These measures will noticeably improve the ability of many Canadians, including many first-time homebuyers in particular, to afford to purchase and own their own home." Levings also added a note of caution. "Overall, these are positive, long overdue changes. That said, I would definitely agree with the concern that house prices could see strong inflationary pressures in the absence of enough suitable supply. Supply, as you probably know, is a big challenge to solve. It will take an ongoing focus by all levels of government to accelerate this side of the equation. Canada Guarantee, the country's other private mortgage insurer, also expressed support for the changes. Mary Putnam, Senior Vice President of Sales and Marketing, said, Canada Guarantee is very pleased to see the increase in the insured cap from $1 million to $1.5 million. The $1 million cap was implemented in 2012 and has not been adjusted despite market movement, so the lift on the cap is welcome. Putnam added that the change will most affect buyers in the $1 million to $1.25 million range, and noted that the cap increase only applies to high-ratio purchases, which are over 80% loan-to-value, while the $1 million cap remains in effect otherwise. The down payment required is 5% on the portion of the purchase price up to $500,000 and 10% on the portion of the purchase price between $500,000 and under $1.5 million, she added. The premium paid is based on the loan-to-value. While some in the industry initially criticized the changes as politically motivated or a financial workaround for a supply issue, Putnam views the increase to the $1 million cap as a step in the right direction. There's no question that we have a supply issue, and I think there are many strategies the government is working on to address the supply side, she said. This was the first time in a while that we've seen anything that supports first-time home buyers. This recent change will support future homeowners and their ability to purchase, particularly in major urban centers like Toronto and Vancouver. As a real estate agent, you play a critical role in helping new homebuyers navigate one of the most important decisions of their lives, purchasing a home. Your expertise and guidance can mean the difference between a smooth, successful transaction and a stressful experience. Given the complexities of Ontario's homebuilding industry, it's essential for agents to stay well informed about how to protect their clients. This is where the Home Construction Regulatory Authority, HCRA, becomes invaluable. As the regulator responsible for licensing new home builders and sellers across the province, the HCRA holds licensees to professional standards, protects the public interest, and enhances consumer confidence in Ontario's home building industry. By leveraging the HCRA's resources, real estate professionals can guide their clients effectively and help them avoid common pitfalls. Here are the top 5 things real estate agents need to know to protect both their clients and themselves. First, check the Ontario Builder Directory, OBD. This is a crucial first step in protecting your clients at the outset. The Ontario Builder Directory, hosted by the HCRA, provides key information about a builder's license status, years of activity, number of projects, and any conduct concerns, including charges or convictions against them. In Ontario, builders must be licensed by the HCRA and demonstrate they meet specific technical and financial competencies. Holding a valid license also means the builder is required to uphold ethical standards, including honesty and integrity in their work. By verifying the builder's license on the directory, you can help safeguard your client's investment from the get-go. Second, beware of unlicensed builders and sellers. Illegal building and selling occurs when new homes are constructed or sold without a license from the HCRA. Purchasing from an unlicensed builder exposes your clients to potential unethical practices and substandard construction work. Real estate agents who knowingly facilitate an illegal sale can face regulatory action from the HCRA, including financial penalties, and may lose their registration with the Real Estate Council of Ontario, RECO. Remaining vigilant is crucial when guiding your clients in selecting a builder. Suspected illegal builders or sellers should be reported to the HCRA through its complaints process. Illegal building and selling can result in significant consequences, including financial penalties and potential jail time. The HCRA actively enforces these rules and has recently laid 124 charges against a builder for illegal activities. Third, avoid illegal house flipping. Reselling or flipping a new home that has never been lived in is a key issue for real estate agents. Even if it was purchased from a licensed builder, the owner cannot resell the home without a license if it hasn't been occupied. The HCRA outlines several indicators of genuine occupancy in their advisory on the common definition of home. So, what exactly is a new home? In simple terms, if it meets the following characteristics, then it may be considered a new home, and a license is required by the owner to sell if it has not been previously occupied, is self-contained, meaning it has the ordinary aspects of living as part of the home, such as eating, sleeping, waste management, and heating, is built as a family dwelling used for residential purposes, is affixed to a permanent foundation, and can be occupied on a year-round basis. It's important to verify the history of any home your client is reselling, including whether it has been lived in or not. Selling a new home without a license from the HCRA is illegal and may result in financial penalties for the seller. You do not need a license for assignment sales. Assignment sales occur when the original buyer of a pre-construction home sells their purchase contract to a new buyer before the property is built or transferred. These transactions are common in Ontario's housing market. Assignment sales do not require a license from the HCRA. However, as a real estate agent, you may still need RECO registration to represent buyers, sellers, or builders involved in these transactions. Even though an HCRA license is not required for assignment sales, it's important to ensure that your clients fully understand their rights and obligations. This will reinforce your role as a trusted advisor and enhance the value you provide. Fourth, ensure your clients are treated professionally. The HCRA enforces a code of ethics for builders, mandating that they conduct themselves with integrity, honesty, and professionalism throughout the home building process. Your clients should expect nothing less, and as their agent, you can help them understand the type of behavior they should see from their builder. This includes zero tolerance for harassment, discrimination, misrepresentation, or bullying of any kind. If you or your clients experience unlawful or unethical behavior from their builder, submit a complaint for review by the HCRA. This includes concerns about their conduct or illegal building and selling activities. By reporting these concerns, you can help the HCRA better protect the public and maintain a level playing field for everyone involved in the market. Fifth, protect your clients and your reputation. As a real estate agent, you're crucial in protecting buyers in today's housing market. By using the tips and resources from the HCRA, you'll not only safeguard your clients, but also enhance your professional reputation. Staying informed about industry standards helps your clients make smart decisions and builds trust in your work. In doing so, you're supporting a fair and transparent housing market that benefits everyone. About half of the 7,020 households on Nova Scotia's waitlist for public housing are composed of seniors, the Deputy Minister of Housing said Wednesday, a number the opposition said should make the government feel ashamed. Seniors also compose more than half of the 1,800 low-income residents living in Nova Scotia's 11,200 public housing units, Byron Rafuse told a legislature committee. In response, New Democratic Party leader Claudia Chender said, "The government should have an enormous amount of shame at the number of seniors that are struggling to make it month to month. Those seniors," she said, "have worked their whole lives and are now on a fixed income, unable to keep up with the rising cost of living." Braden Clark, the Liberal housing critic, said the high proportion of seniors on the public housing waitlist is disappointing and incredibly sad. However, Rafuse said the government is making fairly good progress toward shrinking the waitlist, adding that the province has reduced the time it takes to prepare a unit for a new tenant after the previous residents move out. A government spokesperson said the average time someone spends on the waitlist is 1.7 years. Brian Ward, head of the Nova Scotia Public Housing Agency, said Wednesday that unit turnaround times have been reduced by 25% since December 2022. It now takes 134 days, or almost 4.5 months, for the agency to get a unit ready for a new tenant. Nova Scotia has previously announced it will put $58.8 million toward 273 new public housing units for more than 700 people, with another $24.4 million from Ottawa. The province says these will be built gradually, and so far 17 of them are occupied. All 273 new homes are expected to be complete between 2027 and 2028, said a spokesperson with the Nova Scotia Public Housing Agency. These planned builds mark the first new public housing units built by the province since the 1990s. Rafuse told the committee meeting the province's housing plan will create the environment for an additional 41,200 homes over the next 5 years. He said that in the past year, 4,600 housing units have been built in the province. Clark said the government's ideas for tackling the housing crisis are okay, but the execution is too small and too slow, and too many people are being left behind. The Affordable Housing Association of Nova Scotia says that as of last week, 1,287 people in the Halifax Regional Municipality reported they were homeless. To meaningfully address housing needs in Nova Scotia, the government should throw its support and money behind nonprofits that are equipped to create new affordable homes, Clark said. The government is underutilizing these organizations, he said, and has to be empowering and further the funding capacity and scale of the nonprofit housing sector. Chender echoed these sentiments and said she was disappointed by the government's progress a year after launching its housing plan. During the Wednesday meeting, we didn't learn anything new. We heard the same sort of disappointing deflections that we always hear about housing, she said. They're spending the most ever, and yet we are not meeting any of the needs. In today's Canada, the cradle you're born into increasingly dictates whether you'll ever hold the keys to your own home. This isn't just a market fluctuation. It's a boiled frog phenomenon. Incremental changes, the steady rise in home prices, gradual policy shifts, and slow-moving supply constraints went largely unchallenged. By the time the severity of the crisis was recognized, many prospective homeowners were already cooked. We missed the boat, not because we weren't aware it was leaving, but because we believed we could swim faster than the rising tide. The most recent government initiatives to assist Canadian homebuyers, such as increasing amortizations to 30 years and bumping up the price limit from $1 million to $1.5 million for insured mortgages, have been met with divided reactions. One thing is clear: these measures make it possible to get into more debt and for a longer time. Additionally, policies that increase affordability for some inadvertently make housing less affordable for others. Those without family wealth or who don't qualify for assistance find themselves competing in a market inflated by these interventions, deepening the socioeconomic divide. Recent data highlight the stratification of Canadian wealth. In a report from CIBC Capital Markets with data up to mid-2024, the proportion of first-time homebuyers receiving family help has increased 55% since 2015, from 20% to 31%. The average gift amount for first-time buyers nationally has soared to $115,000, a 73% increase since 2019. In the more expensive provinces of Ontario and British Columbia, average gifts for first-time homebuyers are $128,000 and $204,000, respectively. Mover-uppers, people moving to bigger homes, rely on family gifts to a lesser extent, but those who do get assistance get a lot. Nationally, the average gift is $167,000, while that figure for British Columbia is $230,000. These figures show purchasing a home depends increasingly on one's parents' financial position. The market is no longer a level playing field where hard work and reasonable savings secure a foothold for all. Instead, intergenerational wealth is an increasing factor in who becomes a homeowner. As housing prices boil, Canadians are taking on staggering levels of debt. A report from Statistics Canada earlier this year showed Canada's household debt to disposable income ratio at 185%, the highest in the G7, which averages 125%. Mortgages make up a significant portion, reflecting the lengths people go to secure housing. This debt isn't just a statistic, it's a source of stress affecting mental health and delaying life milestones. High household debt poses risks to the broader economy. It restricts consumer spending and increases vulnerability to financial shocks like job loss or rate hikes. For those unable to buy, renting offers little relief. Rental prices have surged with property values driven by high demand and limited supply. In many cities, rents consume a large portion of income, making it hard to save for a down payment. The cumulative effect is a generational crisis. Younger Canadians find it increasingly difficult to achieve the financial milestones their parents took for granted. The traditional path of education, stable employment, and home ownership is fraught with obstacles often insurmountable without familial wealth. This reality affects more than finances. It affects social cohesion, mental health, and future prospects. Housing isn't just shelter. It's security, community, and a sense of building toward a future. When access is inequitable, the consequences ripple through society. That one's chance of owning a home is determined at birth highlights the deepening divide. It challenges the narrative of Canada as a land of equal opportunity. Instead, we're confronted with a reality where parental wealth overshadows individual effort. Is it hyperbolic to say that it smacks of feudalism? I don't think so. The dream of owning a home remains just that, a dream, for too many Canadians born without family wealth or access to policies that, while helping some, make housing less affordable for others. Well, that wraps up today's episode. Thank you for tuning in to the Ontario Mortgage and Real Estate Insights podcast. I hope you found our discussions enlightening and helpful in navigating the complexities of the housing market. I'm your host, Steve Hamoen, and I'll catch you in the next episode. Until then, stay informed and make well-informed decisions.